Hey, it's Rob. Welcome to the Everyday Investor, the hottest real estate investment show in the world. That's right. I said it. I don't care who knows it. We've got a fantastic show today. We're talking about how to make money in rent-to-owns, lease-to-owns, helping people to get into a property, buying it one day, whether it's a year, 2 years, 3 years, all that kind of good stuff. Remember, when you're introduced to any kind of investment ever, doesn't matter if it's real estate, business, you always want to ask 4 questions. Number 1, what is the return on the investment? Number 2, when do you get that return on investment? If somebody says it's 20% ROI, but it's over 5 years, then really you're only making 4% annualized. Number 3, what's the minimum cash amount needed? And number 4, what is the risk, the worst case scenario? Today, like I said, we're going to be talking about how to make money in the rent-to-own market. I'd rather have nobody on the show than my good friend Simon Giannini to talk about this. Simon, it's great to have you here.
Pleasure as always, buddy. How are you?
Yes, and not just having Simon on the show to talk about rent-to-owns, but we talk spirituality, we talk life, we talk family, we talk about the more important things than making money.
It's all connected.
Although money is great, it helps.
It's all connected.
Right? So this is airing all over Ontario. You're in the Toronto area. Everybody knows Simon Giannini, but just for the 1 or 2 who don't know you, let's talk a little bit about just what you just said there. How money, we can use it as a tool. Not the most important thing, but we use it as a tool for quality of life. Talk a little bit about the philosophy of real estate and why you've been doing it for as young as you look. I think, almost 3 decades now.
Yeah, over 30 years.
Yeah.
Listen, I'm fortunate. I really like the business. I like both investing. I like being a broker. I like educating people about it. And anybody that says money is not necessary is naive. It's up there with oxygen, as a famous man once said.
Yes.
But it can't be the driving force for everything. It is a tool. So balance is important. You've got kids. I've got kids. And that changes your life as soon as you have a child. The focus goes off you.
Yeah.
But at the same time, we have to protect the family's wealth for the next generations. And if we can do that, get good returns, do it safely and conservatively, and have fun doing it, well, we're really blessed in every way, right?
Yeah, absolutely. And, the good book says a man doesn't work, he doesn't eat. I mean, obviously,
that's right.
We need to not be lazy and sluggish and so on and so forth. But there's different ways to be able to make money. And how amazing would it be if we could put out $1 and get that $1 back plus a lot more? And I think that's what you've been teaching for over 30 years now, that there's many ways to make money. Let's talk a little bit about the headlines. Is that, the school system didn't teach us. Our parents, unfortunately, God bless them, they didn't know, so they weren't able to teach us. So people go to media, and we know that's kind of a mistake, unless you're watching The Everyday Investor, of course. But talk about why a lot of people aren't doing this. Why don't we know about these things? I mean, we're going to talk about one specific strategy of the dozens that you know of, and people are going to be enlightened. I know they will be. Why don't more people know about this?
Well, I think the problem is our basic education doesn't teach wealth creation. Our basic educational system, and education is important, but it teaches us get a job, buy a house, pay off your mortgage, and save your money. And if you save your money, hopefully you invest it, and typically we've been taught by Bay Street, invest it in the stock market, just put 10% away. The problem with that is the volatility of the stock market and volatility of some of the other investments that have been traditionally recommended.
That's a great point. I mean, because stocks, really, it's based on emotion. With real estate, I know that's the number one point that you always make. Never base real estate investing on emotion.
Well, a stock play or a mutual fund, it's really based on just one way of making money, and that's speculative for me, because the only way you make money is if the value goes up.
Yeah.
And as we know, as anyone who's bought Nortel or Enron can attest to, sometimes they go down.
Yeah.
So there is a little bit of volatility. And what I like about the real estate market versus the stock markets is the stock markets, we've seen them lose 50% of their value literally overnight. Real estate doesn't do that. It's slow to grow, but it's also slow to drop. So there's a lot of forewarning. So long term, as long as you're okay with the get rich slowly plan, real estate's the place to be.
Yeah, somebody said to me, it's like a yo-yo on an escalator. It goes up and down upwards, right? Real estate.
Perfect. I love that. I'm going to use that.
Yes, please do. Yes.
Yeah.
No, you're absolutely right. And then here in the GTA, I mean, when we come back from break, we're going to look at a few graphs that you brought. But real estate in the last 50 years here in Toronto has went up, I think, what, 6% or so on average?
Well, if you look at that yo-yo, the yo-yo has gone up and down, as you said, but the escalators brought us up on average, all told, even with the ups and downs, 6 to 7%, depending on who you ask.
For the last 50 years?
For the last 50 years.
Wow.
And there's one reason why that most people don't consider, and that is population growth. The city has grown, and when a family lands at Pearson, they can wait a while to buy a car, but they need a place to sleep the first day they're there.
Yeah.
And a good chunk of them are buying right away, and the rest of them are renting, and in both cases, driving demand for housing. So that's why this is the business to be in.
And that's what Mama told me, taught me day one. When you have more demand than supply,
yeah,
I guess we have a business.
Pretty basic, simple principles. Yeah.
Yeah, and so I'd love to get your thoughts when we come back from the break here on all the mortgage stuff that's happening, how that affects real estate. Again, I want people to know you because you know more than one way to make money in real estate. Today we'll talk about rent to owns. We have a couple of friends here.
Yeah.
Anthony and Marlene are with us. Look forward to learning a lot more from Simon Giannini. Thanks for watching The Everyday Investor. You don't want to miss this show. We'll continue in just a moment. Thanks for watching. Whenever you're considering investing in real estate, always ask those 4 questions. Number 1, what's the return on investment? Number 2, when do I get that return, along with the money that I put in? Number 3, what's the minimum cash amount needed? And number 4, what is the risk, the worst case scenario? Hey, it's Rob. Welcome back to The Everyday Investor. Today we're learning how to make money in rent-to-owns, lease-to-owns. Simon Giannini is here. He's going to teach us all about that. But before we talk to Simon about how to make money in rent-to-owns, we're going to go to our mortgage specialist extraordinaire, Carmen Caponero. Over to you, Carmen.
Thanks, Rav. Today I want to talk about shopping. And I mean not shopping for some clothes, which I love to do. I'm talking about shopping for mortgages. In today's market, it is really tough when you continue to seek for financing at multiple banks and multiple brokers. First of all, every time you go to a different institution, they're going to pull a credit bureau. Every time they pull a credit bureau, your credit score is going to go down. So what's happening here is it's going to be more and more difficult for you to get that approval because your credit score keeps going down and it looks like you're shopping, which in our industry, when lenders see that, it's a negative and it could propose a decline. So find somebody that you're comfortable with, let them handle the job, let the professionals do it, and don't shop because it's not going to do you any favors. So back to you guys. Thanks.
Thank you, Carmen. Always great to hear your voice. Simon, we're talking about mortgages, and we know that we don't shop around. It hurts our credit score. Maybe 2 max kind of thing. I want to talk about what's come out even just in the last few days about mortgages and tightening up, and for all intents and purposes, and please clarify, correct me if I'm wrong, but we've increased mortgages, the rate, the interest rate, we've increased it 2.5% without really increasing it. Explain kind of the 2 or 3 things that have happened, and then also your thoughts on, is it a good thing, is it a bad thing, long-term, short-term? What are your thoughts there?
Well, if you think about it, if you look back the last few years, at one point about 10, 15 years ago, the federal government said, you know what, we really want to encourage first-time buyers. So they created 5% down, and they created programs designed to help first-time buyers. And they even created a program where you could actually do, cashback, so literally zero down financing.
Yeah.
And they expanded the amortization rate. So normally, if you get a mortgage, in the old days, it used to be 25 years, that was it.
Yeah.
When you pay your mortgage 25 years, it's paid off. They said, well, let's try increasing it to 30. And then they said, let's try increasing it to 40 to make it easier on first-time buyers.
Because their monthly would be lower, and so that's why we made it longer. And what was the impetus of this? Just to stimulate the economy, or what was the reason?
Stimulate the economy. And
Okay.
Let's be clear. The real estate market, both the resale market and the construction industry, are huge driving force for the economy.
That's right.
It really is good for everybody all concerned. And then as fears started, coming out, and the media, fueling the fires of those fears. Is the market overheated? Is it going to crash? And of course, for the last 10 years in a row, we've heard market's going to crash, it's high, it's this and that.
Yeah.
Well, we can talk at lengths about this, but the fact is this. They made a few changes. First, they went from 40-year amortization to 30 and then to 25. Then they said you can only refinance your house as, up to 80% of value. Now the latest is if you're buying with less than 20% down, you need to qualify at the posted rate as opposed to the actual rates you're going to pay. And the idea is that if the market does change, if rates go up, then these first-time buyers that are at a little bit more risk are in a safer position. My challenge with that is anytime somebody from the government says, hi, I'm from the government, we're here to help, it hasn't worked out, right?
Yeah.
And really, quite frankly, I like the idea of trying to help the market out a little bit, trying to slow things down in a way, but they're impacting the worst sector of the market, the ones that need the most help.
Yeah.
First-time buyers with 5, 10, 15% down.
That's right.
I would have taken a different tack. I would have said, look, why don't we adjust the GDS? The GDS is the rate at which banks qualify buyers. And right now, the typical
It's
GDS...
a percentage of my income.
It's a gross debt service. GDS is gross debt service. So if you have X dollars in income, the bank will say no more than 30% of your income you can use for your mortgage. So
that's a good idea. So we raise it a little bit. So if somebody makes, if a household makes $100,000 a year, your suggestion is, listen, doesn't matter what you do, you can only spend $30,000 a year on housing. That's what you
That's what it is right now.
Oh, okay.
That's what it is right now.
Okay.
Instead of changing the qualification rate, why not just lower the GDS? Why not legislate that the maximum GDS is now 28?
Yeah.
So people can spend a little bit less. And this way we can a little bit more subtly and a little bit more softly adjust what people are investing in, what people are buying in.
Yeah.
But the fact is that if you look at the, and I brought some graphs. I don't know, maybe.
Yeah, let's throw some graphs up on the screen here, so we can talk about that as we put them up. So here's the first one, Simon. What are we looking at?
Here's your yo-yo on an escalator. It's perfect because we see the annual ups and downs and the little minor changes in the graph. And this is going back from 2010 up to 2016 and beyond. We see seasonal changes in the home price, and when we look at that, in the summertime it slows down a little bit as everybody goes to the cottage, and in the wintertime when it gets really cold, well, people stay home and there's less activity in the marketplace. But over time we're seeing a general growth up, and the reason we have seen such a strong growth in the Toronto market for the last almost 2 decades is that because the crash of 1989, which was inevitable because prices were overinflated, brought prices down below to what the median should be. So the GTA real estate market has really been playing catch up for 10, 15 years. And it's pretty balanced right now. And all of the experts are saying the same thing that we've been talking about for the last couple of years. That the market's not going to crash, but what is going to happen is the escalator is just going to slow down a little bit. Right? We're still going to see ups and downs. We're not going to see any major price correction. But some markets are growing much more aggressively than others. Durham region, York region, etc.
So with this now, really, what does it mean at the end of the day for the people watching? It means, and again, correct me if I'm wrong, but it really means that our purchase power is 20, 21, 22% less now. So if I was able to qualify as a first-time home buyer for a home that's $500,000, now I have to buy one for $400,000.
Correct.
As that happens, Simon, does that now bring down? Do you think that the prices will drop slightly? Is that what you mean by a slight correction, softening? Will they drop a little bit, prices, because of this?
I don't think prices will drop.
Okay.
I think what will start to happen is you'll see different sectors slow down a little bit.
Okay.
Okay, and here's what we're seeing a lot of lately. We're seeing it firsthand. That I was able to qualify on my own for $500,000. Well, guess who's going to step in and co-sign?
Co-sign.
Mom and dad are going to come in and co-sign. And I think there's going to be a very small impact anyways.
Okay.
There will be some, and probably the new immigrants that maybe don't have as much resources or don't have those people that are able to co-sign. They're going to be impacted a little bit. But I don't see that. First of all, it's a very small segment of the market, but I don't see a huge impact at all.
Okay, great. Always wonderful to get your wisdom. Let's talk about rent-to-owns. I mean, this is one strategy of many. Let's explain how that works, and then you have a couple of friends of yours that have done this. They've made money in it, and we're going to teach the viewers at home how to do it. So what is a rent-to-own, lease-to-own? First of all, is there a difference between rent and lease?
No.
Okay.
I've been calling it lease-to-own. I don't know why. That's how I heard about it first off.
Yeah.
And whether it's rent-to-own or lease-to-own, it's really simple. Let's say you have a family that has a down payment. They've got a job. but they can't qualify for the mortgage because they've got some issue with their credit. Either they've had a job loss or a divorce, or they've got injured on the job, or something like that.
Yeah.
They can't qualify for conventional financing. If they go to the secondary finance market, the B lenders, or basically somebody that's going to charge them a much higher rate, or someone that's going to require a much bigger down payment, which they can't do either, well, they can come to the rent-to-own. And the rent-to-own is simply this. Let's say I'm the tenant buyer. I can't qualify for the mortgage. You're an investor. Essentially, you're going to buy the house in your name.
Okay.
You're going to rent it to me. I'm going to pay the rent that equals the mortgage, the maintenance, the taxes, everything, and give you a little profit. And as long as I've cleaned up my credit in 2-3 years, I can now qualify at that point for a mortgage and buy the house back from you. So the advantage to me as a tenant buyer is I can get into the house that I want, I can get my family settled in, I can get the kids in the right school and the hockey and all of that. And I don't have to move, I can decorate, and it's really my house, but you're helping me with the financing. So you, the investor, are acting like the bank, and we know the banks make money. So this is a great way for an investor to behave like a bank, offer interim financing in a way. Your investment is secured because you own the property.
So Simon has a great job. He has money in the bank, but for whatever reason, maybe you have a business and some of this money goes into a corporation and it's taking some time to...
Self-employed as well, absolutely.
Self-employed.
Yep.
There's a blemish on credit. For whatever reason, this great banking system of ours has tightened up. You cannot get a mortgage today.
Correct.
If you go to what we call a B lender, you can get a mortgage, because anybody can get a mortgage. It just depends how much interest you're going to pay.
Exactly.
So it won't be fruitful for you to take on that mortgage from the B lender.
Or possible. It could be sometimes as high as double the rate.
Okay, so now here comes Rav, who says, okay, I will help you. We'll get you a property, Simon, that you and your family enjoy in the neighborhood that you want to be in. Does that work that way? There's no property first, we go look for one together? That makes sense to the both of us?
It's a great question, because traditionally what a lot of the rent-to-own systems that are being taught out there basically say, go buy a property and then go find a tenant buyer. Well, it's very difficult to find a tenant buyer, let alone find a tenant buyer that likes that exact house.
Exactly. So Simon and his family are going to find a property. I've got to feel good about it just in case you don't close on it. It's still got to make sense as an investment property. We do that. Again, I think it's, what you said is, now they're in the right neighborhood. They are in the school system. They're set up. And usually these Simon's going to buy that property from Rav. Usually, what period of time do we set these up?
Usually 2 to 3 years.
2 to 3 years.
I think our most common term is 3 years.
Yeah.
And we connect the tenant buyer with credit repair company to help them fix their credit.
Yeah.
We make sure that from the get-go that their income will qualify them for the mortgage on the back end. And the only thing that we have to repair in the meantime is the credit. And 18 to 24 months is usually a minimum time to clean up credit.
Yeah.
So that's 2 to 3 years.
Okay. So now they're paying all expenses. So for Rav, what I like about this as an investor, we haven't even talked about the return on investment. I mean, it's amazing. But what I like is I don't do any of the work, because in spirit, this is Simon's house. Even though legally it's Rav, in spirit it's Simon's. So the light bulb and the cutting of the lawn and the driveway and every single thing that happens, you're responsible for, because in spirit it's your home.
I'm living in it as if it's my house, and I just haven't closed the deal yet.
Okay.
That's really what it is.
I like the way you put that. That's great.
And the tenant buyer is giving you a deposit towards the purchase, and that's a non-refundable deposit. So you're getting, with the rental laws in Ontario the way they are, all you can collect from a tenant is first and last. With this program, you can collect first and last, and you can get $10,000, $20,000, $30,000 up front, and there's no property management. So it really is a nice scenario for investors.
Then you mentioned a little bit of a bump. So on top of all the expenses, there's a little bit of a bump, whether it's a couple $100, whatever it is monthly. Do I keep that, or does that go towards their, is it a credit towards them buying the house?
The tenant buyer gets a credit towards the down payment, because we need to build up their down payment over time, right?
Yeah.
They need to get to 5 to 10% over the 3-year period.
I see. So it's not like they have the full deposit. They have a chunk of it, and they're saving to build up as well.
Absolutely. And well, they save to build up the down payment. They need closing costs. They need legal fees. So we figure out a budget for the tenant buyer that makes sense and is logical, and something that they can comfortably manage as well.
Yeah. Okay. No, that's great. I can't wait till we have who we're going to bring on first.
We're going to bring on Anthony first.
Anthony first, and we're
Yeah.
going to look at what he's done, and we're going to look at the returns and all this kind of stuff.
Yeah.
Very, very exciting. We're going to continue to talk with Simon and friends. When we come back, we're learning how to make money in lease-to-owns. Don't go anywhere. We'll be right back. Thanks. Did you know that the Greater Toronto Area population is expected to grow by over 2 million people over the next 20 years? Hey, it's Rav. You're watching The Everyday Investor. We're talking about how to make money in lease-to-owns, rent-to-owns. Simon Giannini is with us. He's my expert co-host on this subject matter. And we have our good friend Anthony Tabar here. He's going to teach us how he made some money just with this concept, investing in lease-to-owns, rent-to-owns. Anthony, great to have you on the show.
Thanks, Rav.
Thanks for being here.
Thank you.
So you're in the real estate world. You actually help people get their portfolios going, buying, selling, all that kind of stuff.
That's right.
But you're also an investor.
I am.
And so one of the strategies you used was the rent-to-own, lease-to-own. Why did you decide to go this route? What do you like about it? What's the pros? Is there any cons that we have to be aware of? Talk to us a little bit about that.
Well, when Simon introduced the investment to me, I liked it because I know exactly what I'm making from start to finish. Everything is preset out for us. The returns every year are set. I know what we buy the property for. I know what we sell the property for. The only risk in my eyes was if the tenant doesn't follow through and doesn't buy the property. In a downward market, I could see how an investor would see that as a risk.
Yeah.
In an upward market, you almost hope that the tenant doesn't buy the property.
Yeah. Okay, so in this case, we're going to look at one. Did the tenant buy the property?
She did not.
She did not buy the property?
For whatever reason, she, at the end of the 3 years, told me, I've decided not to purchase the property.
Yeah.
I'm walking away.
Okay.
Panic set in. We spent $10,000, fixed up the place, put it on the market, and sold it for more than we had promised to sell it to her for.
And when you said originally the reason why you like this, Anthony, is because you know ahead of time what your minimum returns are going to be. That's because you and, we'll call her Jane, you and Jane have this all written out. There's a legal document there, Simon. I mean, how does one structure this?
There's many ways to do it, but how we do it is there's a lease and there's a separate option to purchase agreement.
Okay.
So if the property was purchased today for X dollars and the market is appreciating 5% a year, we'll come up with a slightly more conservative number, and we'll say, maybe 4%. If the market's appreciating by 6, it might be 5. And we'll prefix the price at which the tenant buyer can buy the property from us at the end of the term.
So Anthony said, if there's a down market as an investor, we may think twice. But even with that, we're still getting debt reduction. We're still getting the deposit that they gave us up front.
Yeah.
So how do we lose even in a down market?
We really can't lose even in a down market because in this example, I can't remember what the exact deposit was. Probably what was the deposit, Anthony, on this one?
We put 57.
Let's actually go there.
No, from the tenant.
The tenant from the deposit was 5%. 5% of the property.
Okay.
Okay. So what was the purchase price on this property?
Purchase price was $265.
$265 is the purchase price.
Yeah.
And then what do we? I want you to get me to the ROI. You don't have to reveal the ROI right now.
Sure.
But get me there.
Okay. So let's
what do we
go
do?
through the numbers. The down payment and the closing costs was $57,000.
So this is what Anthony did out of pocket.
Yeah.
$67K.
Yeah.
That was for the down payment.
20% legal fees.
Sure.
Land transfer tax.
Got it. You're in for this.
$57K plus $10K renovations.
Okay. So plus
So just
we'll go 10K on our renos. So this is $67,000 you're in for.
Yes.
Correct?
Okay.
Okay.
And annual cash flow, because the way we structure the deal is Anthony actually pays the mortgage,
Yeah.
the insurance, and the property tax.
Okay.
We add a little bit of a bonus on there.
Okay.
A portion of the bonus is credited back towards the tenant, but in the interim, Anthony gets a positive cash flow of $1,920 a year, $1,920 a year,
Okay, so let me just understand this for a second. $1,920.
and $20.
And $20. That's how much you got over the year.
Yeah.
So you're getting 160, 170 bucks a month.
Mm-hmm.
That is from the to-be purchaser.
Yes.
Jane.
Mm-hmm.
She's giving Anthony 160 bucks a month as a credit to be used towards when she buys.
Correct.
Only if
Only
she buys.
if she buys.
If she doesn't buy, then
That
I
goes-
keep this thing.
Correct.
And so here we are at 1920 a year. That's what it equaled. Okay.
Plus, the tenant, if you look at the numbers, the tenant gave 5%. So in this example, it's $13,000 down.
$13,000. So the what do we call that?
Well, it's a non-refundable option fee,
Option fee. Okay.
which is if and when the tenant buys, is a down payment towards the purchase price.
Okay.
You can call it an option fee, or you can call it a down payment.
And how much was that?
5% of the purchase price.
Which
so
was?
$13,250.
$13,250.
$250. Which is paid up front.
Up front.
So if you look at the $67K Anthony invested, it really wasn't $67K. It was actually $67K minus the 13 and change. So
Okay.
43,000.
Well, we'll leave it
yeah.
here and then we'll just divide them out, right? Does
Yeah.
that still work? Yeah.
Yeah.
Okay. So this is what we did here.
Yeah.
Then.
Now, over the course of 3 years,
Yes.
Anthony's making the mortgage payment.
Yes.
So we have a principal recapture or a mortgage paydown. And the mortgage paydown, we've got annually $43.96.
Pay down.
Yep, $43.96.
$43.96.
$4,396.
That's how much money went under the mattress, paying down the mortgage,
Mm-hmm.
so on and so forth. Now, we're looking at it this way because Jane didn't close on the property.
Correct.
If she did close on the property, I want to talk about that in a second.
Yeah.
But right now, we're talking about what really did happen. So we have the mortgage pay down, and then we also have the inflation of the property naturally.
Yeah. Well,
Right.
we predicted $20,333.
What do you mean predicted? Like it actually did happen, right? It's not
actually-
worth $265 anymore.
Correct. Correct. But we do two things. Number one, we forecast what it could be.
Yeah.
So if we were going to forecast 5 or 6%, it would have been $11,000, $12,000.
Yes.
We look at the actual appreciation.
Yeah.
The actual appreciation worked out to $20,000 per year, based on the final selling price.
$20,000 per year.
Per year, $20,333. Because in 3 years, the property went up $61,000.
Okay. So 20. So you want me to write 20,000 here?
$20,000. Yeah.
So $20,000. What percentage is that, really quickly, on my?
On that
my
one, it works out to
265?
about 8%.
8%.
Seven-
Okay.
7 or
Okay.
8%.
Yeah. Just
Still-
when I look at this
still
and I
not
look at this, this
crazy.
looks huge, but it's
not.
really only that's average in Toronto.
Yeah.
That's what was happening there.
About 8%. Yeah.
Okay. Now, actually, where was this property?
Whitby.
In Whitby. Okay, great. Just east, on the east side there.
Yeah.
Okay. So I think I'm done with the numbers, unless you have something else.
No, that's it.
That's it, right?
Yeah.
So we take all these numbers up. And do we have that added, or do I use my trusty?
No,
calc-
we have
You
it
have it
added.
here?
So total annual return was $26,649.
26,000. Okay.
Divided by, if you divided it by 67,000, which was the total down payment and rental costs.
So of course, remember, guys, whenever we're trying to find a return on investment, we take our profit, which is all these things, equals almost $27,000, and we divide it by the money that you're into. So what Simon is saying is, if I take 26,649 and I divide it by the 67, that should spit out. Move the decimal over twice. That should spit me out what?
40%.
40%. So you made, Anthony, 40% annualized.
He actually made more.
Because
and I'll tell you what, he didn't really invest 67.
Yeah.
He invested 67, but he got 13,000 up front. If the tenant had bought it, he wouldn't have kept that 13. It would have been applied as a credit towards the tenant. But
That's
because
right.
the tenant walked, he kept the $13,000. So really his upfront was less than 54,000. And
then we would have to take it off here too. Wouldn't it be the same thing?
Well, no, the total return is the same, but the investment shrunk. So his actual ROI, because the investment shrunk, is 49% per year.
Got it. Because you want to take 13 away from the 67.
Yes.
right? And then
I got to keep this too.
and you get to keep this, but I'm not going to include that number.
No, we
because I
didn't.
already took it off here.
We're not going to include this number.
Yeah.
We're adding 1, 2, and 3
Yes,
to get us here.
yes. And we're going to not have 67. We're going to have 53, 50,
7.
whatever the case is.
Yeah.
Okay, great. So now, so you made 40%, and the thing that I want the viewers to understand at home is we don't wish this upon anybody. We want
No, we
Jane
don't.
to get in the property. Now, if Jane decides, I mean, Anthony doesn't know because it seems like she's a private woman, nothing wrong with that. If Jane, had a change of heart, she's moving, she met somebody, she's getting married, she's moving to wherever she's moving to, it's all good.
Yeah.
You didn't do a thing.
I saw her twice.
You saw her twice
the
in
entire
3 years.
3 times. One, when we first met, we signed a lease agreement and we signed an agreement of purchase and sale post-dated for 3 years.
Yeah.
That was our first meeting. She gave me 10 post-dated checks for the first year. Year 2, I saw her once to pick up the second year's checks. The third year, she said, I'll leave them in the mailbox for you. I didn't get to see her. I told her I could bring you a bottle of wine on Christmas. She said, thank you, but no thank you. The most private tenant I've ever seen. Like I said, I saw her twice.
And when you say you saw her, 2 or 3 times, I mean, I've had properties, Simon has properties. We haven't seen our tenants either, but our property manager has.
Right.
Here, there was no property manager, there was nothing. It was Jane taking care of her own property.
She painted, she cut the grass, she took the garbage
Because
out.
it's her property, in a sense.
Exactly, and that's how I made her feel. I said, listen, this is your house. I will be as involved as you'd like me to. She said, you stay away. It was really like a soundless investment. I didn't hear from her.
When Marlene comes on the show, was it the same thing, or did that person actually?
That person actually bought the house.
Okay, so we'll look
Yeah.
at that when
Yeah.
Marlene comes.
Yeah.
So since was this your first rent to own?
That was my first rent to own.
Okay.
Actually, when I met Simon, I said, listen, Simon, I'm not a risk taker. I need to know everything that's going to happen from point A to point B, and that's exactly what happened. And in fact, we under-promised and it over-delivered.
That's right.
So, I mean, everything worked out great.
So
This in essence is the worst case scenario.
yeah, no, absolutely.
In
I
essence,
mean, 40% is fantastic. I mean, really, what that means is, you put your dollar out there, and you're getting the dollar back plus 40 cents on your dollar. I mean, that's fantastic. I mean, people hope in the what do they call those things, RSPs or something? They hope for
They hope for 7 or 8.
3 or 4, 5 cents
Yeah.
to be able to do that. You're getting 40 cents on your dollar.
Does this have final sale price?
The final sale price on that
Because we agreed to sell it to her for $310, but we actually ended up selling it for $326.
for $326.
So-
Okay, and we put that in here
And we
on
put
the,
that in.
on,
Yeah,
the, on the
yeah,
inflation.
that's right.
So you decided to sell it for $310. You sold it for $326. That's just because that's what the market
That's what the
dictated
market
at the time.
called for
Yeah.
at the time.
I mean, nobody has a crystal ball. We don't know what's going to happen.
Listen, Canadians are conservative and they're nervous. So we always, when we designed this system, we designed it in a way that,
Guilty.
if the market is, present company included,
yeah.
if the market is, forecast to go up 6, 7, 8%, we design it with a lower interest rate forecast for 2 reasons. A, to make it a little bit more conservative. B, to make it fair for the tenant buyer.
Yeah.
And at the end of the day, we've had many situations where the tenant buyer actually closes, probably about 70, 80% of the time, it actually closes. And, our investors are happy for the family. Hey, I make money, I'm helping out a family, it's a win-win-win.
No, absolutely.
Yeah.
This is good for the person that wants to establish. They want to lock in now. 4 or 5 years from now, you don't know if that person's selling in that neighborhood.
Yeah.
But something comes up. Anthony is my investor. Rav wants to get into a certain area. Something came up. Hey, Anthony, can you help me out?
Yeah.
So we really are helping the person. And when that happens, this $13,250 goes back to Rav. Let's say I'm the purchaser. That goes back to Rav, and the credits that I gave goes back to Rav.
Yeah.
So, it's not like, but you still win at the end of the day as an investor, and there was nothing to do.
Yeah.
If I hadn't given those back, I still would have been up. Maybe not at 40%, but I would have.
Congratulations,
Yeah,
my
I would
friend.
have. Yeah.
Very, very, very exciting. Exciting what happened to Anthony. He's making money. We're going to have Marlene on the show in just a few minutes. You don't want to go anywhere. The Everyday Investor continues in a moment. Did you know that over the last 50 years, the GTA real estate market has averaged over 6% growth year over year? Rav, welcome back. We're learning how to make money investing in real estate, specifically rent-to-owns. I'm here with my good friend Simon Giannini. He's teaching us how to do that. We just learned from Anthony how he really made about 49% annualized. If you missed that, you want to go to Rogers TV, make sure that you see the repeat. But have no fear, because we have Marlene Cornacchia on the show. And of course, we all know that women are more savvy investors than men. Marlene, correct?
I concur.
Yes. Great to have you here
Thank
on
you
the
very
show.
much,
Thanks for being here.
Yeah.
You've kind of been in and around the real estate world for a while as well.
Yes.
And one of your strategies was the rent to own, the lease to own. Tell us a little bit about that. And the same question that I asked Anthony, why rent to owns? Pros, cons? Why did you like it, enjoy it? You obviously made some money doing it.
I did. I'm a strong advocate for it. I was introduced about 5 years ago. I am an investor as well as a realtor.
Yeah.
I like the idea of having tenants that have a vested interest in the property. So it's great to have rental properties, but it's also great to have tenants who actually will take care of the property.
Yeah.
So that to me is, a weight off my shoulders.
It's a great point. We call that, a pride of ownership. Like
Absolutely.
with our principal residents, there's a pride of ownership. It's the same thing. Where else are you going to find a tenant having a pride of ownership other than this scenario? I think that's very wise.
Yeah.
So you did one of these, two of these?
This is my second.
Okay.
So I did one. It worked out amazingly well. I was, fortunate enough to have really good tenants. Ultimately, repaired their credit at the end of the term and were able to purchase. I was thrilled because I was able to help them.
Yeah.
And they were so happy and so grateful.
Yeah, I'm playing around when I say women are more savvy. What I really mean, and I think, Simon, you would concur, our default as men sometimes is money. That's kind of our default. Not to say we care. I mean, I listen, yours truly cares, but our default, is, watch me play Monopoly with my family, you'll wonder if I'm their dad, Yeah. With women, I kind of find like, their default is they're smart enough to say, hey, I need to make money, but their default is more to help and to take care. Do you find that?
Yeah.
Absolutely. But you know what I find too? I've got a lot of clients that just came in and said, just show me the numbers, and then they get to know the family, and then the deal closes, and you know what, become friends, and you can see there's a genuine happiness for them.
Yeah.
Because it really is a good program for tenant buyers. Because the other thing that we really haven't talked about is this. If a tenant buyer is coming to the table with 5% down, their mortgage, their payments, all of their costs are based on a 95% mortgage. Well, when they do a rent to own, their mortgage is based on an 80% mortgage loan to value.
Because the investor is the one that helped out with the other 15%.
Because the investor is putting 20% down because it's an income property, so the payments are actually lower than if they had perfect
That's a great
credit.
point.
Yeah.
And they get used to paying these, monthly. They're used to being able to pay this, plus the credit that they're giving for their deposit when they buy,
Right.
And even though it's a myth, the other good thing about rent-to-owns that I find is what's a myth is, for when we try to get investors to get into the investing world, well, what about the tenancy nightmares? Well, if you do your due diligence, you really shouldn't have tenancy nightmares. But how much more, as Marlene, you said, when they have a pride of ownership and feel like this is their own home?
It's
They got
almost
skin in the game.
Yeah,
they
they
got
do.
skin, absolutely.
Yeah.
So, okay, let's go through the numbers here and let's find out what our ROI is going to be at the end here. And the good news on this one, not that Anthony's wasn't good news, Jane had a change of heart, but here our tenant buyers closed on the property.
Correct.
Okay, so tell me what I'm writing down here.
Okay.
Well, purchase price was $385.
Yeah.
$385, okay. And what area are we in?
In Oshawa.
In Oshawa, okay. So that's my purchase price.
Yep.
Okay, what else?
Down payment.
Down
and closing
payment,
costs?
$77,000 down payment.
$77,000. Is that a certain percentage?
That's
20%.
20%.
20%, okay.
Yeah.
Plus a little bit of close, is that what you put there?
Yep.
Okay, so we're all in for 77?
No,
No.
8,300
8,300.
for closing costs.
Okay, so plus 8,300 to close.
Okay.
It was already renovated, so no renovation costs.
Okay.
And we should subtract
Yeah.
the 5% down that the tenant gave us.
Okay, so
Yeah.
what's
Okay.
that going to be? So we're going to take away, how much is 5% down of this? 16?
18,000.
18,000.
Yeah.
18K, and we called that the option fee.
or the down payment, which,
Yeah.
which was really, this is what it was at the end of the day.
Okay.
Okay.
Here's my writing, everybody. So we had 20% down, $77,000. We closed for $8,300, but they gave us the deposit,
Correct.
which was $18,000. So you, Marlene, are in for what?
67,300.
There you go.
67,300. That's what you're in for. Okay. So let's see how much money we make, and then we'll figure out our return on investment there.
Okay.
Okay.
So how do we make money in a rent to own when the tenant buyer actually buys?
Sure. Well, let's walk through it.
Okay.
In this case, there was annual cash flow of 3360.
So the cash flow is 3360. So
Yeah.
this is about what, 280 a month or so?
Something like that. Yeah.
3360 the year. Okay. Then
The annual mortgage reduction
yeah.
is 9215.
So mortgage pay down is how much?
9215.
9215
15.
for
And
the
that's
year.
just, that people are wondering where that number comes from. When you get a mortgage, you get an amortization schedule, and it shows you how much is principal, how much is interest.
Yeah.
And we just look at the mortgage statement, and we know in advance how much we're going to make on an annual basis.
And is there kind of a rule of thumb percentage-wise? I mean, I guess it depends on what the interest rate is at the time, but I'm guessing that the mortgage amount was probably, I mean, this is 9215 over the year tells me that that's about $750 a month. So her mortgage payment was probably what, $1,500-$1,600 a month?
Yeah, it's close to about 40 to 45%.
40% goes under the mattress. The rest goes
Correct.
into what we garbage or interest,
Interest,
or
yeah.
whatever the case
Yeah.
is for the bank.
For the bank.
Okay,
yeah.
great. So mortgage pay down $92.15.
Yeah. And then the actual appreciation, because we had a prefixed amount.
Yeah.
The actual appreciation was $19,250.
So appreciation.
Yeah.
It goes up in value. For 1 year, it was
19,250.
okay.
Okay.
So that's how much it went up.
Yeah.
And so this deal, Marlene, was over what period of time?
3 years.
3 years.
Yeah. 36 months.
Okay.
Yeah.
And that's what you said. They're roughly about 3 years. 3 years old. Okay. So anything else here? This is how we made our money.
That's it.
Yep.
Yeah.
Okay. So, do you have that there? Or do you want me to get the calculator?
I do. We have
We
it.
have
We
it.
have it added up. It's 31,825.
31,825.
825.
Okay. So, tell me about. Okay, no, we'll keep going. Then I'll ask the question after. So this is just the straightforward again. Take the 31,825 because this is what Marlene made, and divide it by what she's in for.
Correct.
That's what we're doing.
Yep.
Okay.
So we take 31,825.
Yeah.
Divided by 67,000.
Divided by 67,300.
Gives us 47%.
47%. Annualized.
Annualized. Now, when we do the final calculation,
Yes.
it's going to be a little bit lower. It's going to be closer to 42%.
Yes.
Because we've got to credit back.
That's what I was going to ask.
Yeah, we've
Yeah.
got to credit back the down payment of 18,000
Yeah.
to the tenant.
Yeah.
And we're going to credit back half of the 3360.
Yeah.
So the way we typically do it is of the positive cash flow, 50% goes to the investor and 50% goes to the tenant buyer. So in this example, they'd get a $1,600 credit on closing, and that would reduce the purchase price.
It's a forced savings.
Yeah.
for them
So
as
when
well.
you decided that it was going to be $260 a month, where did you get that $260 a month?
We worked it with the tenant. We looked at their
Affordability.
budget.
We looked at that, and you looked at market value of what's
We
going
look at
on in
market
the
value, yeah.
area.
Yes.
We look at two things. We look at what can the tenant comfortably spend, and we usually give the tenant options. Option A is this amount. Option B is this amount, and on whichever payment they choose, they save half.
Got it.
So we look at their budget, and we also look at what are they going to need at closing.
Yeah.
Because they're going to need their down payment plus closing costs at a new price, whatever the future price is. And we set it up so that their income can qualify them for that price, and that they're going to have enough cash to close.
Yeah.
Got it. No, it's all systematic.
Yes.
So half of the cash flow, because they bought, if they weren't going to buy, everything remains the same. Because they purchased, half of the cash flow goes back to them towards a credit.
Yeah.
Correct.
And then also their 18,000 option fee goes back to them. So we have to increase this. No, we don't increase this.
No.
What
It
we do
just
is
goes back to them
Yeah.
because they've decided to take the option to purchase.
Correct. Yeah.
This is reduced
Yeah.
by 6,000. So the total
What's reduced by 6,000?
This is reduced by 6,000 because 18,000 is credited over 3 years.
That's right.
So the appreciation rate drops a little bit.
Got it.
But the investment up front is the same. So it's coming off
And
the
so
top.
you still make over 40%.
Correct.
You still make 40%. So either way, whether they buy or they don't,
Yeah.
we hope they buy.
Yeah.
But if they decide they don't want to for whatever reason, then
Yeah.
that's good too. You're still making I forgot the handsome gentleman that was just before us.
Anthony.
Anthony.
Yeah.
We're still making over 40% on our dollar.
Correct. Yeah.
And I'll tell you, here's the thing about rent to own that investors like.
Yeah.
We design the deal from the beginning.
Yes.
If the deal doesn't make for the investor at least 25 or 30%, it doesn't make sense to do the deal.
Yeah.
Yeah.
So we design it that way up front, and we also look at the needs of the tenant buyer. We budget everything to the dollar. So the tenant buyer knows exactly what they're paying. They know exactly what the monthly is going to be. They know how much is their responsibility. And we want to make sure that we want to set them up for a win.
Yeah.
Because at the end of the day, we've got to protect our money as an investor. However, there's nothing wrong with being able to help the family at the same time. So we want to make sure they know what are they going to need at closing.
So, Simon, when you help me buy an investment property, just the traditional investment property, I buy it, I rent it out. When I look at the inflation, when I look at the debt reduction, when I look at the cash flow, and I add all those three numbers against my 20% down, I'm making 25% minimum.
Correct.
So the advantage of this, I mean minimum, I mean I can make 30, 40% in a traditional buy and hold. I guess the difference is the perspiration, the headache that comes with it.
Absolutely.
Is that really what, for the viewers watching at home and saying, what's the difference? The difference is whether somebody closes or not, you're making the 40% range, but there's no work, there's no headache, there's no wondering.
Hugely
no
attractive.
work, there's no vacancy, there's no property management. This is what I hear from the investors.
Yeah.
They're so happy that it's completely passive. They get their 36 post-dated checks, they don't hear anything. And the way we design it, we oversee the property as well. So we do a semi-annual check. We as the broker. So I'm a broker. I'll put the deal together.
So the people that are watching at home, there's people that are watching that may be the tenant that want to get into the market. So they're watching at home, they're the tenant buyer. There's other people that are watching. I mean, the show is called The Everyday Investor. We're just everyday people.
Yeah.
Investors are watching this. So they contact Simon, Simon's team, and we help them get into this type of scenario.
We're matchmakers.
Yes.
But not in the familial sense. We're matchmakers in the investor world. So we help tenant buyers get into the home before, if the banks don't qualify them, we help them get in. We help investors do passive investments. Many of our investors will do a rent-to-own. They'll also do a traditional purchase. They'll get involved in passive investments.
Fantastic
We help them
stuff.
figure it all out.
Yeah.
Great to have you.
Thank you.
Yes, we've
Thank you.
talked to Marlene. She's taught us how she's made over 40% on her dollar. The Everyday Investor continues in a moment, and we'll hear from Simon on his closing thoughts. Thanks for watching. If you have any questions pertaining to this show or there's a topic that you would like covered, please visit www.rogerstv.com. Hey, it's Rob. Welcome back to The Everyday Investor. We've had a phenomenal show talking to Simon Giannini and friends. We've been learning how to make money in rent-to-owns. Simon, thank you so much for being on the show. Like always, I love your parental thoughts to the viewers at home. What would you say to them for the people that are watching in the concept of investing in real estate, whether it's rent-to-owns or anything else for that matter?
Well, you know what I've always said, there's no shortage of opinions on the real estate market, among other things, and just make sure that when you're listening to an opinion, that it's a qualified opinion. My barber has an opinion, my butcher has an opinion, not necessarily qualified opinions, but they're opinions nonetheless. And the same thing with the media. We live in one of the best cities in the world. We have one of the best and strongest real estate markets in the world. So if you want to understand what's going on, get the opinion from the source. In fact, I was telling you on break, we just finished up a new book,
yes,
which is understanding the real estate market, understanding how to invest, and understanding how to create a retirement plan for Canadians right here in the GTA.
When does that come out?
It comes on book stands in February, but just for your viewers, I'm happy to provide a sneak peek with a draft copy. All they have to do is call and request a copy, and we'll send that information out.
Fantastic. Thank you so much for being so
always.
giving to the viewers at home. You heard it here. Just contact Simon to get that free book ahead of time. On behalf of Rogers TV and myself, Rav Toor, we'll see you next week, same place, same time. Honey, I love you. I'll be home soon. Ciao, everyone.